Sunday morning to 47 a.m. While most of America slept, silver exploded to $83.75 an ounce. Then, in 70 brutal minutes, it collapsed to $75. $4 billion in long positions vaporized. By Monday afternoon, whispers started spreading through trading floors. A major bank had failed to meet its margin call. Hundreds of millions of ounces supposedly caught on the wrong side of the trade. The Federal Reserve allegedly pumped $34 billion into the banking system just to stop the bleeding. But here's the twist. Nobody can confirm if any of this actually happened. No official statements, no emergency press conferences, just a crash market and a lot of terrified investors staring at red screens. So what really went down that Sunday morning? And more importantly, what does it mean for everyone still holding silver? Let's rewind to understand how we got here. Silver didn't just wake up one morning and decide to hit $83. This was a rocket that had been fueling up for months. Back in January of this year, silver was trading at a comfortable $30. Nothing special, just another commodity doing commodity things. Then the industrial demand machine kicked into overdrive. Electric vehicles need silver for their battery systems. Solar panel installations are breaking records every quarter. Data centers require massive amounts of silver for their electrical components. Suddenly, silver wasn't just a shiny metal people collected. It became the backbone of the entire green energy revolution. But the real bombshell dropped in November. China, the world's largest silver consumer, announced something that sent shockwaves through the market. Starting January 1st, 2026, any company wanting to export silver from China would need special licensing. Translation: China was about to lock down their silver supply. The Shanghai premium, the extra amount Chinese buyers were paying over Western prices, exploded to $7 or $8 per ounce. Think about that for a second. If you could buy silver in New York for $75 and instantly sell it in Shanghai for $83, you'd empty every vault in America. And that's exactly what started happening. Meanwhile, silver climbed from $30 to $50, then $60, then $70. The stage wasn't just set for something big. It was rigged to explode. Friday, December 27th. This is where things get interesting. Silver had been grinding higher all week. But Friday morning something changed. The metal gapped up overnight, jumping from $70 straight to $79. No gradual climb, just a violent leap that left technical analysts scrambling to redraw their charts. Then the whispers started. At 9:30 a.m. Eastern, the Federal Reserve's repo facility got tapped for $17 billion. For context, that facility exists so banks can quickly get cash when they need it. $17 billion in one morning. That's not normal. That's someone in serious trouble. 8 minutes before the closing bell, someone placed a $429 million options bet on SILJ, the Silver Miners ETF. Not a hedge, not a spread, a pure directional bet that silver was about to move hard. Trading floors lit up with speculation. Who drops the kind of money with 8 minutes left in the day? Someone who knows something. That's who. By the time the market closed, the rumor mill was in full swing. A major bank, reportedly non-US based, was sitting on a massive short position. We're talking 49,689 contracts. At current prices, that's $20 billion of exposure. And allegedly, they couldn't meet their margin requirement. Here's where you need to understand what a margin call actually means. When you short silver, you're betting the price will fall. But you don't own the silver you're selling. You borrowed it. Your broker requires you to keep cash in your account as collateral. If the price moves against you, that collateral shrinks. Eventually, your broker calls you up and says, you need to deposit more cash by the end of the day, or we're closing your position. That's a margin call. And if you can't pay, your broker doesn't wait. They hit the sell button, dumping your entire position into the market at whatever price they can get. Now imagine that happening with billions of dollars of silver. The price doesn't just drop, it craters. Sunday night turned into Monday morning. Most markets were closed. Thin liquidity, perfect conditions for chaos. At exactly 2:47 a.m. Eastern Time, according to traders watching the overnight session, silver spiked to $83.75, the highest price in decades. Then the floor fell out. 70 minutes later, silver was trading at $75, an $8 plunge in little over an hour. $4 billion in leverage long positions got liquidated automatically as stop losses triggered in sequence. It was a cascade. One position getting forced out triggered the next, which triggered the next. Like dominoes falling in fast motion, the rumors exploded faster than the price dropped. A European bank, some said, hundreds of millions of ounces short. Executives allegedly spent Sunday afternoon desperately trying to raise $2.3 billion in emergency capital. They called every major Wall Street bank, Morgan, Goldman Sachs, Morgan Stanley. According to the whispers, every single one looked at the bank's position and said no. Too risky, too exposed. By Monday morning, the Federal Reserve had allegedly injected another $34 billion into the banking system through emergency facilities. Not a bailout, just liquidity to keep the gears turning. But the damage was done. Silver had been absolutely destroyed. Then the CME, the Chicago Mercantile Exchange, where silver futures trade, made their move. December 29th, they announced a margin increase for the second time in 2 weeks. They were raising the amount of collateral required to hold a silver position. Initial margin jumped from $20,000 to $25,000, a 25% hike. If you're a trader holding 100 contracts, you just got hit with a $675,000 bill. Come up with the cash or get liquidated. History started flashing warning signs. In 2011, when silver was making its last major run, the CME raised margins 5 times in 9 days. Silver crashed 30%. In 1980, when the Hunt brothers tried to corner the silver market, the CME literally changed the rules mid-game. They implemented Silver Rule 7, which restricted new buying and only allowed liquidation. The Hunt brothers went bankrupt. The pattern was clear. When silver gets too hot, the exchanges turn off the gas. But here's where the story takes a turn. As the week progressed and the panic subsided, something became obvious. There was no bank failure. The FDIC didn't seize any institution. The Federal Reserve didn't issue emergency statements. Bloomberg and Reuters, the most plugged-in financial news sources on the planet, reported nothing. The rumor was traced back to a guy named Hal Turner, a known conspiracy theorist with a history of pushing unverified claims. The bank collapse story? Probably fiction. But here's the twist that makes this whole thing fascinating. The market reaction was completely real. Silver did crash. Billions in positions did get liquidated. The Fed did inject massive liquidity. So if there wasn't a bank failure, what actually happened? The answer is simpler and maybe scarier. The market deleveraged itself. Silver had gone parabolic. Much money, too much leverage, too fast. The CME raised margins. It forced traders to either add cash or sell. Many couldn't add cash. They sold. Selling triggered stop losses. Those stop losses triggered more selling. Algorithms that control most trading these days saw the trend break and flipped from maximum long to neutral or even short in a matter of hours. It was mechanical, cold, efficient, and it didn't need a bank failure to happen. There's a detail that makes this story even more complex. PMO or GAN. According to SEC filings, Morgan had quietly flipped their position over the past year. They went from being one of the largest short sellers of silver to holding 750 million ounces of physical metal, 750 million ounces. It's not a trading position. That's a strategic accumulation. While retail investors were panicking and selling paper contracts, smart money was buying physical metal by the truckload. The crash wasn't about fundamentals changing. It was about leverage getting purged from the system. Talk about what happened to the physical market while the paper market was imploding. Spot price crashed 11%. Think dealers would be offering fire sale prices on coins and bars? Right, wrong. Eric silver rounds were still selling for $8 to $10 over spot. That's a 14% premium. A healthy market, premiums are $2 or $3. A $10 premium means the supply chain is broken. Dealers were telling customers, can't get metal at the spot price. Refiners are charging us $78, so we have to charge you $82. Spot price had become a fiction created by the forced liquidation of paper contracts. Had completely detached from the actual cost of getting physical silver into your hands. Meanwhile, in Shanghai, the arbitrage gap widened to over $8 per ounce. You could theoretically buy silver in New York for $72 and sell it in Shanghai for $80. That gap acts like a rubber band. The further it stretches, the more tension builds. Eventually, it snaps the price back. Physical buyers in China were looking at this crash as the buying opportunity of the year. While Western investors were panic selling, Eastern buyers were preparing to drain every available ounce. COMEX inventories, the physical silver backing futures contracts, have dropped 70% over the past 5 years. The vaults are getting emptier. Paper market and physical market were breaking apart in real time. What does all this chaos actually mean for the future? Is the silver bull market dead? History suggests not even close. 2011, silver crashed 30% after a parabolic run. 6 months later, it had recovered most of the losses. March 2020, silver dropped from $18 to $12 in a week, a 30% crash. The Fed printed $3 trillion to fight the pandemic. Silver went from 12 to 30 in 5 months. Pattern repeats, parabolic rise, violent correction, eventual recovery. Corrections are painful, but they're not the end of the trend. The reset button that allows the next leg higher. Here's something crucial that happened on January 1st. China's export licensing requirement officially took effect. A company wanting to export silver from China now needs government approval. This isn't a rumor or speculation. It's official policy. China is locking down their silver supply right as global demand is exploding. Crash might have actually created the perfect entry point for institutional investors. At $85, silver looked expensive and risky. $72, after a correction, it looks like a viable dip to fund managers with billions to deploy. There's also the year-end factor. Late December, fund managers are booking losses for tax purposes. They bought silver at $78 last week and sold at $72 today. They can use the loss to offset gains elsewhere. Once the calendar flips to January, that artificial selling pressure disappears. Leverage got destroyed, but the fundamentals didn't change even slightly. Samsung still needs silver for their phone batteries. Tesla still needs it for their electrical systems. US military still needs it for Tomahawk missiles and radar systems. Solar panel installations are still breaking records. None of that industrial demand vanished in 70 minutes of overnight trading. The debt clock is still ticking. Governments are still printing money. Supply deficit is still real. Change wasn't the world's need for silver. Change was how many speculators were holding leverage paper positions betting on short-term price moves. It was the uncomfortable truth that this crash exposed: leverage is the enemy. Those traders who bought silver on margin, borrowing money to amplify their gains, got completely wiped out. They watched silver hit 83 and thought they were geniuses. 70 to hit, and their brokers force liquidated their positions at the worst possible moment. They didn't just lose their profits, they lost everything, including the cash they started with. Meanwhile, the person holding physical coins in a safe deposit box, their position didn't change at all. Same number of ounces, no margin call, no forced selling. It's patience and time on their side. Crash was violent, ugly, and terrifying for anyone watching it happen. But it was also predictable. Parabolic moves always correct. Always. Deeper the rise, the harder the fall. Silver went from $30 to $83 in less than a year. That's not sustainable. The market needed to shake out the weak hands. Over-leveraged gamblers, the momentum chasers who didn't understand what they owned. That process happened in 70 brutal minutes on a Sunday night. The market is cleaner. Leverage is gone. Euphoria has been replaced with caution. And historically, that's exactly when the next major move higher begins. Whether the bank failure story was real or fabricated doesn't actually matter. The message is the same either way. This market will destroy you if you rate playing with borrowed money. It will fake you out, and liquidate you at the worst possible moment. But if you understand the fundamentals, if you own physical metal instead of paper promises, you can handle the volatility without panicking, then these crashes become opportunities instead of disasters. The world is still running out of silver. That fact hasn't changed. Change is the price the panicked sellers are willing to accept for it right now. But where does silver go from here? The technical analysts are watching $70. The level holds. The bull market remains intact. It was just a violent test of support. 70 breaks. We could see a drop to 65. The physical arbitrage gap and industrial demand create a floor somewhere in this range. Silver can't stay cheap for long when there is $8 of profit available by shipping it to Shanghai. The question isn't whether silver recovers. It's how long the recovery takes and whether you can survive the volatility to see it. Be sure to hit the like button if this breakdown helped you understand what really happened. Drop a comment with your thoughts on where silver goes next. Subscribe because this story is far from over. Leverage got crushed, but the squeeze is still building. We'll be tracking every move.